Hello, everyone. It is Colby, the DGI Crab. Happy Saturday to you. After a lot of reflection and consideration, I have decided to make a change to the Tier 4 ETF strategy and add a couple of new ETFs to that group. Tier 4 is for the high income seekers, the people that need the income from their dividends as soon as possible. If you're new to this channel, the way that I've broken things down around here is I have taken 60 high quality dividend stocks as well as a collection of different very popular quality dividend paying ETFs, and I've split all of that stuff out into different categories or age tiers that are based on your time horizon to retirement and how long you're going to need those dividends to be able to fund your lifestyle moving forward. So when I say tier 4, I'm talking about folks, generally speaking, that are 54 years or older. If you are adding new funds to your portfolio to generate more income through dividends and you're young, you probably shouldn't be focusing on a lot of this high yield stuff. You want stuff that's going to grow those dividends aggressively year over year. It's going to work out a lot better for you, in my estimation. But at 54 and older, you don't necessarily want stuff with a really low starting yield and a 10 or 15% year over year dividend growth rate because just not to be morbid, but the statistics say you might not have as many years to enjoy those 10 to 15% dividend raises. So you've got to jump in and get that income right here and now. Now, I'm not a licensed professional advisor, so do your own due diligence. This is just me sharing my personal strategy and my opinions on investing with you. So my current group of tier 4 ETFs is the largest group of ETFs for each of the tiers. Tiers 1, 2, and 3, I'm typically just looking at about 4 different ETFs, and I put half of my income every single month or half of my investable income every month into those ETFs. Tier 4 is the same way, but as of up to today, we were looking at 8 different ETFs, a 15% allocation in SPYD, which gives me the 80 highest yielding S&P 500 stocks. SPYD, very low expense ratio, decent starting yield. Usually you're looking in the 4 to 5% range on the SPYD starting yield, and the share price and the dividends have been pretty consistent over the years. They trade, I don't want to say completely flat, but there's not a ton of dividend or share price growth with SPYD. But it's a simple strategy with a low expense ratio that's going to be a very safe place to park your money. SPHY, 5% allocation gives me exposure to high yield bonds and a monthly payer. PFFA, 5% allocation. This is preferred shares. This is something along with the bonds and the MLPs and the next one up, MLPX, that you just are not going to have exposure to leading up to age 54 if you're buying things like the S&P 500, if you're buying things like SCHD or VYM. So you want to start thinking about in your older years diversifying out the different types of investments that you have. So that way you're not only getting decent income month over month, but you're getting it from a variety of sources. So if one sector is struggling, another sector might be doing better. This is going to provide you with a lot of stability. And also with MLPX, you're going to get all those publicly traded MLPs without the extra tax form, that extra K1 tax form that you'd have to get if you individually own some of those MLPs. And then Devo, SPYI, and JEPQ are my covered call trio up to this point, 5% into each. Devo's going to give me a monthly payer with very respectable share price and dividend growth. And SPYI and JEPQ are going to give me higher yielding monthly payers that are going to write covered calls on the S&P 500 and the NASDAQ 100 respectively. So I've got my bases covered there with a couple of those major indexes. And then finally, a 5% allocation into VYMI so I can have the exposure to the international markets, the non-US stocks. So if I'm adding 2 new ETFs to this list, where am I going to go here? Am I going to invest more than 50% of new money into ETFs? Or am I going to take that from somewhere else? And what I decided to do here was I was going to do an SPYD reduction and reduce that allocation on a go forward basis down from 15% to 5%. So this is going to give me 10% of my weekly allocation freed up to go toward those 2 new ETFs. So what are they? Glad that you hung around this long, because the first one is going to be IYRI. This is a NEOS ETF that is all about real estate. IYRI is going to give me exposure to real estate stocks. It's going to give me a very high monthly yield, generally in the 10% or better range. And that yield is going to be more tax advantageous than simply owning standard REITs like Realty Income, NNN REITs, Vici Properties, whatever REIT you are a big fan of out there, because REITs are taxed as normal income, not qualified dividend income. IYRI, while it's not going to be quite as tax advantageous as something like SCHD, which is all qualified dividend income, it is going to be a bit better than simply owning straight up REITs or a REIT ETF like VNQ. I talked about IYRI with Jeremy over at Dividend Stockpile a little while back. You should go check out that interview with Jeremy where he breaks down IYRI and why this is an ETF that's baited into his portfolio. I wanted to get a little bit more real estate exposure overall with this tier 4 group. And while there are 4 REITs that I have in my group of 60 individual single stocks, I still thought that maybe getting a little bit more real estate exposure at this point would be a good idea, and getting it in a somewhat more tax advantageous way than just simply having something like VNQ and the really high monthly yield made IYRI look like an absolute no-brainer. The other addition I'm adding to this group is another NEOS fund, BTCI. This is going to give those current income seekers exposure to Bitcoin. BTCI has a very high monthly yield. It has, as Jeremy pointed out in that aforementioned video where we also talk about BTCI, this one has at times yielded up above 30%. So very high monthly starting yield. Now, it's a little bit interesting in that basically with this ETF, there's roughly about 25% of it is ownership in Bitcoin ETFs. And then the remainder is a synthetic covered call strategy where they're writing futures contracts on Bitcoin. So it's a very interesting strategy. It's not necessarily anywhere near the same as simply owning some Bitcoin in a wallet or in hard storage somewhere. And if you are a younger investor, maybe just having some allocation dedicated to Bitcoin or to one of the Bitcoin ETFs out there, because you don't necessarily need to have high starting yield right now. For the current income seekers, adding on to Bitcoin probably doesn't make a whole lot of sense. It's a very volatile investment, obviously. It's gone way up, it's gone way down. Over the long haul, it has gone up a lot more often and a lot more aggressively than it has gone down. But if you are a retiree or you're nearing retirement age and you're really trying to get that dividend yield up to the point where you can live off of it, allocating even a small amount of money over to just Bitcoin itself and hoping that it grows probably isn't the best strategy for you, because if you need the income, eventually you'll end up needing to sell some Bitcoin. And when is the best time to sell Bitcoin? It's really hard to say. When is the best time to sell an individual single stock? Well, when it looks like it's trading expensively, and there's certainly a lot of metrics you could use when it comes to individual single stocks to make that determination. With Bitcoin, that seems a lot more difficult to time if you ask me. Now, I'm not a crypto expert, and I would imagine a lot of the 54 and older investors that are looking for that immediate income probably aren't, in large part, Bitcoin or crypto experts themselves. But this is going to provide a lot of nice income coming in every single month in US dollars that you can utilize to fund your retirement. And it's going to give you exposure to the crypto market. So my breakdown moving forward is now I'm putting 5% into 10 different ETFs each time I add new money to the portfolio if I'm in that 54 and older tier 4 group. And just to cover it one more time, what we're looking at here is SPYD, which gives me straight ownership in high yield, large and mid cap stocks. SPHY to give me high yield bonds. PFFA will give me preferred shares. MLPX will give me MLPs. IYRI will give me tax advantaged real estate. BTCI will give me Bitcoin that generates cash flow. Devo will give me a covered call ETF with growth potential. SPYI will give me a covered call strategy on the S&P 500. JEPQ will give me a covered call strategy on the NASDAQ 100. And VYMI will give me straight ownership of high yield international dividend stocks. So loads of diversification there. And you can imagine that at different times, different markets and different investment allocations are going to have their ups and downs. So if the stock market is way up and we're getting a lot of overall growth, but crypto is struggling and real estate struggling, and then the preferred shares are just kind of languishing around, then that's great. And then in times where the stock market's really struggling, we're going to have some diversification into the bonds, into the covered calls, so that way we're still generating money even when share prices aren't going up all that aggressively or even going down. So when I do the video tomorrow, the weekly Sunday video, where I'm going over each of the 4 tiers and where I think that money ought to be allocated for the week, you're going to see this new breakdown in that tier 4 section where 50% of the new money is going to be going into these 10 ETFs, 5% each. I want to make sure that for the 54 and older investors, not only are you generating a lot of consistent monthly cash flow to fund your retirement or for just dividends that you're reinvesting to help you get to that point, that you're getting it from a lot of different places and from strategies that seem very sound with reasonable expense ratios, because that's the name of the game. We want to be able to not only generate that income, but not put it into just high yield trash that's eventually going to cut dividends, do reverse stock splits. A lot of you can guess what types of funds I'm talking about out there. These, I think, are all going to be pretty stable moving forward and give you the income that you need all at the same time. So let me know what you think down there in the comments below. And a shout out especially to Jeremy over at Dividend Stockpile. Go over and check out his channel as well, where he goes into several of these ETFs, including when it comes to NEOS interviews with their primary fund manager, Troy Cates. So you can really get a deep dive into some of those strategies and learn a lot more about them over there at Jeremy's channel. And I'll link our interview down there in the description below. Thanks so much for tuning in, you all, and I'll see you next time.